Hey everyone, and welcome to the Deep Dive. We're going to take a deep dive into the world of startups and small businesses today. Are you ready to decode all the lingo?
I'm ready. Let's do it.
Because we're going to unpack all those essential terms and concepts that every entrepreneur should know.
Yeah.
And our guidebook for this journey is the Essential Startup and Small Business Glossary. We're going to try to uncover the secrets behind those businesses that go from like just a tiny spark of an idea all the way to like, a booming IPO, right?
Absolutely. It's so fascinating because whether someone's already launched a few ventures or is, just kind of daydreaming about their first business idea, knowing these terms can be a total game changer, right? It's like suddenly you're speaking the same language. You're at the table. You're part of the entrepreneurial conversation.
You're in the club.
Exactly.
All right. So first things first, let's talk about the MVP. We hear it all the time, right?
Yeah.
Minimum viable product. Now, we've all heard this term thrown around, but it's so much more than just like quickly throwing together a prototype, right?
Right.
It's about finding this balance between keeping things simple but effective, actually solving a real problem for people without getting, too bogged down in all the little details and making it perfect.
Yeah, exactly. Think about companies like Airbnb. They didn't start with this like massive global platform. I mean, they started really simple, renting out air mattresses. Basic website.
Air mattresses, that's it.
It sounds super basic, but it solved a problem. You know, it proved that their idea had legs. And more importantly, they got feedback from real users from the very beginning, which helped them improve and grow.
Yeah, it's like dipping your toes in the water before you do like a cannonball into the pool, right?
Exactly.
So you've got your MVP out there, you're learning from your early users, and then this like magical thing happens. You know what I'm talking about, right?
I think I know what you're talking about.
Product market fit.
Oh, yeah, PMF.
Or, as the cool kids call it, PMF. This is like the aha moment. You realize, wait a minute, I've created something that people actually want. And suddenly your whole focus shifts. Right? You're not hunting down customers. You're figuring out, how do I scale this thing up? How do I meet this demand?
Absolutely. And a great example of that is Instacart. They started by like laser focusing on this small group of users who were just crazy about their grocery delivery service. And that early success, that was like rocket fuel. It gave them the confidence to scale their operations and, reach a much, much wider audience.
It's like, you're going along and then kaboom, you're like, all right, we're on to something here.
Totally.
Okay, so you've got your MVP, you've got product market fit, everything is looking pretty good. But how do you fuel this dream? How do you keep the lights on?
It's the $1 million question.
Let's talk about funding.
Yeah.
And the good news is there's not just one path. There's like a whole buffet of options. We've got venture capital, angel investors, grants, accelerator programs, even crowdfunding, harnessing the power of the people.
It's amazing, right? So many options, and each one has its own, unique flavor and considerations. So it's about finding the right fit.
Totally. So let's start breaking these down a little bit, starting with venture capital, often called VC for short. So this involves professional investors, and they are looking for big returns, comfortable with a certain level of risk.
Right. They're in it to win it.
And they provide funding in exchange for equity. So that means, they get a piece of ownership in your company.
It's like they're placing a bet on your success. And if you hit it big, like, the early investors in companies like Google or Facebook, everybody wins big.
Everybody wins. It's a good bet to take, right? Now, let's say you're not quite ready for the big leagues of VC, right? Yeah. Angel investors are another great option.
Yes.
These are individuals, often successful entrepreneurs themselves, who invest their own money in early stage startups. So typically the amounts are, smaller than VC funding, and they often take a less hands-on approach, letting you kind of, steer the ship a little more freely.
Yeah, they're like your, experienced friend. They've been there, done that, and they're there to offer guidance and support. But they trust you to run your business.
That's important, right? And don't forget about grants.
Oh, yes. Grants are like golden tickets. I mean, they're non-repayable funds provided by governments or organizations.
Free money.
Free money. It can be huge, especially if you're working on a project or in a sector that, aligns with their objectives. Like, for example, here in the U.S., the SBIR program, it's helped tons of small businesses get off the ground.
Yeah. And over in the EU, we've got Horizon Europe, another great example of a program that's offering grants for innovative startups.
Absolutely.
So let's move on to accelerator programs.
Okay.
They're like boot camps for startups.
Boot camp.
Right. You get intensive mentorship, funding, and access to a whole network of investors and potential partners.
Yeah, think Y Combinator, Techstars, 500 Startups. These programs can be absolute game changers. They help refine ideas, scale quickly. They just, push you forward.
It's like a crash course. Right.
Exactly.
Okay. And lastly, we have crowdfunding, harnessing the power of the people. You raise funds from a large number of individuals, often through platforms like Kickstarter or Indiegogo. Right?
Yeah, and what's cool is you can offer rewards for different levels of support, or even give people the chance to own a tiny piece of your company through equity crowdfunding. It's like, everyone's in it together.
It's the community aspect of it, right?
Absolutely.
So we've got all these different funding paths. It's like, which way do I go? But how does this all actually work when you secure those investments?
Yeah, where do you start?
So that's where understanding the stages of startup funding comes in. So let's say you've got this brilliant idea for, an app, right? And you need some initial capital to build that MVP and get things rolling. That's where seed rounds come in. It's like the initial spark to get that engine going.
Right. It's like watering the seed, giving it what it needs to sprout.
Right. And then once you've proven your concept with your MVP, and hopefully you've started to achieve that product market fit we talked about, you might look at series funding rounds.
Yeah, so we're talking Series A, Series B, Series C, and so on.
The alphabet of funding.
Think of it like leveling up in a game. Each round typically brings in larger investments, which helps you scale operations, expand into new markets. Really take things to the next level. Like, for example, DoorDash, they used early seed rounds to get their food delivery service off the ground. And then all those subsequent series rounds fueled their, rapid expansion, tech development, all of that.
It's like building momentum, right? Yeah. Each round pushes you further.
Absolutely. It's like you're getting that snowball rolling and it just keeps getting bigger and bigger.
All right. So all this growth and development, it requires fuel, right? And in the startup world, that fuel is cash.
Yeah.
So this brings us to another important concept, burn rate. It's basically the rate at which a startup spends money each month.
Yeah, this one can be a little scary for some people.
It can be. It sounds scary.
But, it's crucial to keep a close eye on, especially in the early stages, before you're consistently profitable.
Yeah, and that's because your burn rate is directly tied to your runway, which is how long you can operate before needing more cash.
Right. How long can you keep the lights on?
Exactly. Got to keep the lights on. So understanding your runway, that's absolutely vital for financial planning, especially if you're pre-profitability. It helps you make smart decisions about hiring, marketing spend. You know how aggressively you can pursue growth.
It's about making sure you don't run out of fuel before you reach your destination.
Right. You don't want to be stranded halfway there. Now, of course, the ultimate goal for any business is profitability. That sweet spot where your revenue exceeds your expenses. You're not just surviving, you're thriving. Now, startups, might prioritize growth and scale in those early stages. Sometimes they even delay profitability to capture a bigger piece of the market.
Right. It's all about strategic decisions based on your goals. Think about a small business like, your local bakery or that independent bookstore that you love, They need to be profitable pretty quickly to keep the lights on, pay their employees, keep those pastries baking, and those shelves stocked.
Now, this pastries, got to have those books, got to have those employees, got to have the lights on. So what if you are someone who's really passionate about maintaining control of your business and you want to avoid giving away too much equity in those early funding rounds?
I feel that.
Bootstrapping.
Yeah.
That's where it comes in. This is all about building your company with your own sweat and tears, using your own personal funds, reinvesting those profits to fuel growth.
And there are some amazing success stories out there, like MailChimp. They built a billion-dollar business by bootstrapping.
That's incredible, right? It shows you that it's totally possible. It does require a certain level of discipline. You got to be resourceful, and you got to hustle, know? Absolutely got to hustle. But the beauty of it is you retain ownership. You call the shots. You're the boss.
You answer to yourself.
Which is incredibly rewarding. Okay, we've covered a lot of ground already. We've talked about MVPs, product market fit, all those funding options, even touched on bootstrapping. But let's dive a bit deeper into some of the tools and strategies that startups use to secure funding, manage their finances effectively. We've got convertible notes, safe notes, stock options. It's a whole alphabet soup of terms that can be a little intimidating.
Yeah, it can feel overwhelming at first, but it doesn't have to be.
Not at all, because we are going to break it all down in a way that makes sense. So let's start with convertible notes and safe notes.
Okay.
These are clever ways for startups to raise money early on without, getting bogged down in those complex valuation discussions.
Right. Nobody wants to be bogged down.
No, keep it simple. Right. So essentially, they allow investors to provide funding that converts into equity later during a future funding round.
Yeah, it's like kicking the can down the road a bit, but in a good way,
Yeah, strategic can kicking. And then we have stock options. This is a way to incentivize and reward employees by giving them the right to purchase shares of the company down the road, usually at a discounted price.
It's all about sharing the success, giving everyone a slice of that pie.
Everybody gets a piece. Right.
Okay.
So the bigger the pie gets, the more everyone benefits.
Mm-hmm.
All right, let's shift gears a little bit and talk about how startups assess the potential of their ideas and how investors figure out how much a company is actually worth.
Right. How do you measure that?
So this brings us to two really important concepts, TAM and valuation. So TAM, or total addressable market, helps you understand the overall size of the pie, so to speak. It's that total revenue opportunity available for a specific product or service.
Yeah, it helps answer the question, how big can this thing get?
And then you've got valuation, which is basically an educated guess about how much a company is worth at a specific point in time.
It's like trying to put a price tag on potential.
Yeah, it's influenced by all sorts of factors like, funding rounds, market trends, and of course the perceived future potential of the company. So a high valuation, it doesn't necessarily guarantee success, but it does tell you that investors are, pretty optimistic about the future.
They're seeing dollar signs.
Right. They see the potential.
Mm-hmm.
Okay, let's fast forward a bit and talk about exit strategies. Now, this might seem a bit premature, but it's actually crucial for both founders and investors to have a plan for how they will eventually profit from their investment.
It's about having an end game in mind.
Right. You got to know where you're going. So the two most common exit strategies, acquisitions and IPOs. We've all heard about those crazy acquisitions, right?
Oh, yeah, the big ones.
Like when Facebook bought WhatsApp for, I think it was $19 billion.
It's mind-blowing.
It's an insane amount of money, right? That is a prime example of a very successful exit for both the founders and those early investors.
Everyone's popping champagne.
Everybody's happy, exactly. And then there are IPOs, or initial public offerings. So this is where a private company goes public, allowing anyone to buy shares of the company on the stock market, often seen as a major milestone.
Right, like you've made it to the big leagues.
You're on the big stage now.
Yeah, and a good example of this is Zoom. They went public through an IPO, and it was a huge success. Created a lot of wealth for the founders, early investors, everybody involved.
Everybody wins again.
Everyone wins. IPOs, they can be a little bit of a roller coaster, but when they're successful, they're incredibly rewarding.
All right, so that was a whirlwind tour of some of the key concepts and terminology in the startup and small business world. We covered a lot, but hopefully you're feeling a little bit more confident navigating this whole landscape.
Yeah, hopefully we demystified some of those terms and you're feeling empowered, but we're not done yet.
Not even close. We've got more to explore. We'll be diving into some even more fascinating concepts in the next part of this deep dive. But for now, let's take a quick pause. And when we come back, we'll unpack some essential metrics. These are metrics that every entrepreneur, whether you're running a tech startup or your own, local bakery, needs to understand.
It's all about measuring success and making smart decisions. We'll be right back.
We'll be back. All right, welcome back, everyone. So we've made it through all the twists and turns of startup lingo, from MVPs to IPOs, but now it's time to shift gears a bit, right?
Absolutely, time to get down to brass tacks.
Let's focus on those crucial metrics, those numbers, those data points that can make or break a business. But don't worry, we're not diving into complex spreadsheets here.
All right, we'll keep it practical.
Yeah, no, we're going to explore these metrics through real-world examples, scenarios you can actually relate to, so it's easy to understand and apply to your own ventures wherever you are in your journey.
It's like having a dashboard for your business. These metrics help you understand what's working, what needs attention, and ultimately, whether you're on the right track for success.
Totally. It's like your business GPS, right?
Yeah.
It's telling you, hey, you're going the right way, or, maybe we need to make a U-turn.
Exactly. It's all about having those insights to make informed decisions.
So let's start with a metric that's super important for businesses with a subscription model. Annual recurring revenue. We're talking ARR. the lifeblood of these businesses. It's what provides that steady, predictable stream of income that every business owner dreams of, right?
Oh, yeah, predictable revenue. That's like music to my ear.
Well, it's like, okay, I can breathe now.
Yeah.
So let's say you have a software company. You've got 50 customers, each paying $1,000 annually for your amazing service. Well, your ARR would be a cool $50,000. That's not bad.
Not bad at all. And that predictability, that's gold. It allows you to plan for the future, make those strategic investments, and just track the overall health of your business with a lot more confidence.
Yeah, you know where you stand. All right, so we've got ARR telling us how much revenue we can expect to see coming in year after year. But what about the cost of acquiring those valuable customers in the first place? Enter customer acquisition cost. You know it as CAC.
CAC, gotta love it. It's all about those expenses involved in attracting and converting a new customer. So we're talking marketing campaigns, sales efforts, maybe you're offering free trials, creating awesome content, even those delicious cookies you're handing out at your pop-up shop. It all adds up.
Everything counts. It's an investment. So let's imagine you're launching this brand new online fitness program, right?
Yeah.
And you decide, okay, I'm going to run some targeted ads on social media. You spend, say, $2,000 on those ads and you acquire 100 new customers. Well, in this case, your CAC would be $20 per customer.
Okay, so you're spending $20 to bring in each new customer. But the big question is that a good investment? How do we know?
Right, because sometimes you spend money and you're like, wait a minute, did I get my money's worth? That's where lifetime value comes in, LTV, all about measuring that total revenue you expect to generate from a customer.
Yeah.
We're not talking about, a quick fling. This is a long-term relationship.
Long-term value, absolutely. Think about building lasting relationships, not just one-off transactions.
Exactly. So if your, fitness program costs $50 per month and the average customer sticks around for, let's say, 6 months, your LTV would be $300.
Okay, so in this scenario, your LTV of $300 is way higher than your CAC of $20. That's a good sign, right?
That's a fantastic sign. It means your customers are loving what you're offering, they're sticking around, and they're bringing in more revenue than it costs to acquire them. That's how you build a sustainable, profitable business.
You're building a loyal following. It's all about providing value that keeps people coming back for more.
So we've got ARR, we've got CAC, we've got LTV, and now it's time to talk about, keeping those customers happy. Unfortunately, not all customer relationships are meant to last forever.
That's life.
That's life. So here comes churn rate, that percentage of customers who decide to part ways with your product or service over a specific period.
Think of it like a leaky bucket. You keep pouring water in, but if there are holes, you're never going to fill it up.
Right, you got to plug those leaks. So let's say you're running a subscription box service, maybe for those adorable pet toys. Everyone loves those. You start the month with 1,000 subscribers, you lose 50, your churn rate is 5%. It might not seem like a lot.
But those little leaks, they can add up over time.
They do. It's like drip, drip, drip. Pretty soon you've got a puddle.
Right.
So how can businesses keep that churn rate low, keep those customers happy?
Well, it's all about exceeding expectations. Go above and beyond. Understand why people are leaving, address their concerns, and keep innovating, keep providing that value, like with that pet toy subscription box. Maybe the toys aren't durable enough. Maybe the selection's not exciting. Maybe customer service needs a little boost. By figuring out those pain points and making improvements, you can plug those leaks, keep those customers happy, and coming back for more.
It's all about the customer experience, right? Making sure they feel valued. So we've covered ARR, CAC LTV, churn rate. It might seem like a lot to keep track of, but trust me, understanding these key metrics is absolutely essential.
It's like having a secret weapon for your business.
It really is. It helps you make informed decisions about your pricing, your marketing, customer retention, your overall business strategy. It's like having that compass guiding you towards success. It's like, okay, I know where I'm going now.
You're not just wandering aimlessly. You have a roadmap, a plan.
Exactly. No more wandering. All right, we've talked a lot about funding, growth, those exit strategies. But before we move on, let's circle back to a question we asked earlier. As you're, envisioning your entrepreneurial journey, which funding model really feels like the best fit for you, for your vision, your risk tolerance?
It's a big question. Are you drawn to the fast-paced world of venture capital? Or does the community-driven approach of crowdfunding resonate more with you?
Maybe it's the independence and control of bootstrapping that really speaks to you.
It's all about finding what aligns with your values and your goals.
Each path has its own unique advantages and challenges, right? It depends on what you're building, how comfortable you are with risk. For some people, that rapid growth fueled by VC funding, that's the dream. But for others, the thought of giving up equity or facing that pressure to deliver those, hockey stick growth numbers can be a bit overwhelming.
Absolutely. You have to weigh those pros and cons carefully. Bootstrapping, it sounds great because you maintain control, you build at your own pace, but it requires a ton of discipline, resourcefulness, and you're wearing all the hats for a long time.
You're doing it all. And crowdfunding, well, that's a powerful way to tap into a community of supporters, people who believe in your vision.
Right. It's like having a built-in cheering section.
But you got to build that community, create those campaigns, and manage all the logistics. So at the end of the day, the best funding model, it's the one that feels right for you.
It's your journey, your business.
Exactly. All right, so we've been on quite a journey today, right? Exploring a whole bunch of concepts, terms, things you need to know to navigate the startup and small business landscape.
You've covered a lot of ground.
But this is just the beginning.
This is just the tip of the iceberg. The world of entrepreneurship is constantly evolving. New ideas are popping up all the time, new technologies, new business models. It's all about continuous learning, experimentation, and of course, a whole lot of passion and determination.
Yeah, got to have that passion. And speaking of new developments, let's take a quick detour and explore a platform that's caught our eye, Selldone.
Selldone, interesting.
They're kind of positioning themselves as this all-in-one solution for starting and growing a business. And what's really interesting is their open source and no plug-in approach.
Oh, I like the sound of that. So many entrepreneurs struggle with those constant updates, compatibility issues that come with all those plugins.
It's like a never-ending battle, right?
It's a headache.
It's like trying to build a house of cards on a wobbly table. But Selldone, they're trying to solve this problem. They provide a whole suite of tools right out of the box. You don't need all those plugins. And that open source nature, it gives users more control, more flexibility to customize their businesses.
It's all about streamlining those operations, reducing that complexity, empowering those entrepreneurs to focus on what really matters, building amazing products and services.
Yeah, no more tech headaches. Focus on what you're good at. It's a refreshing approach, especially for startups, those small businesses who maybe don't have the resources to deal with all that complexity.
Absolutely. And it's great to see innovative platforms like this making entrepreneurship more accessible and empowering. It really shows that the world of business is always evolving. There's always something new to learn and discover.
Always. And that brings us to a final thought-provoking question for you all to ponder as we wrap up this part of the deep dive. As you consider your own business aspirations, what steps can you take, like today, to actually move closer to making those dreams a reality?
What action can you take right now? Maybe it's finally launching that MVP you've been thinking about, or connecting with a mentor who can guide you.
Maybe it's researching different funding options, diving deep into your target market, refining that business plan. Every step, no matter how small, it takes you closer to your goals.
Absolutely. Remember, entrepreneurship, it's a marathon, not a sprint. There will be challenges, there will be setbacks, but there will also be those incredible moments of joy and triumph.
It's a roller coaster, but it's a fun one.
It is. So embrace those ups and downs, learn from every experience, and never, ever give up on that spark of an idea that ignited your passion in the first place.
That's what it's all about. All right, that wraps up this part of our deep dive. We'll be back soon with more insights and inspiration to help you navigate the exciting world of startups and small businesses. Okay, so we've covered a ton of ground in this deep dive, right? I mean, we've gone from the essential terms and all that lingo, funding strategies, even touched on some cool platforms like Selldone. But before we wrap things up completely, let's circle back to those super important metrics we discussed. The numbers.
Absolutely. Those metrics are like, vital signs for your business. They're giving you those insights into how healthy your business is, how it's performing. Let's start with annual recurring revenue. Good old ARR. The heartbeat of subscription-based businesses. That steady, predictable income stream. Imagine you're running a successful online course, right?
Okay.
They've got 100 students. They're each paying $50 per month. That means your ARR is, a very healthy $60,000 per year.
That's amazing. I mean, having that predictability, that must be such a relief for business owners, right? Like knowing what to expect.
Absolutely. It allows you to plan for the future, make those big decisions with more confidence, like hiring, marketing spend, even developing new products or services. Now, let's switch gears to customer acquisition cost. We're talking CAC,
CAC, the cost of bringing in those new customers.
Right, because attracting new customers, it doesn't happen magically. It takes effort, it takes investment. We're talking marketing, sales, maybe you're offering free trials, discounts, you name it.
You got to get those customers in the door.
Yeah.
So let's say, for example, you're launching a new line of, I don't know, organic skincare products.
Okay, nice.
And you decide, okay, we're going to do some influencer marketing. You spend, let's say, $5,000 on those campaigns, and you acquire 250 new customers. Your CAC, $20 per customer.
Okay, so you're spending $20 to get each new customer excited about your amazing skincare line. But how do we know that's a good investment? Is it worth it?
Right. Is it paying off? Well, that's where lifetime value comes in.
LTV.
LTV. It's all about understanding that long-term value of each customer, not just that initial purchase, but, how much they spend with you over time.
The lifetime of that relationship, it's valuable.
So let's say your average skincare customer spends $100 per order and makes, maybe 4 orders per year. Well, that means your LTV would be $400.
So in this case, the LTV of $400 is much higher than your CAC of $20. That's a really good sign.
That's a fantastic sign. It means you're making a profit from each customer over time, which is crucial for sustainable growth.
It's like planting a seed that grows into a money tree.
I love that analogy. Okay, so we've talked about getting new customers, but keeping the ones we already have, that's equally important, right?
Oh, absolutely.
And that's where churn rate comes in. It's that percentage of customers who decide, you know what, I'm out, and they leave over a specific period. So imagine you're running a streaming service, you've got 10,000 subscribers, 200 of them decide to cancel this month. Well, your churn rate would be 2%.
Okay, 2%. That might not seem like a huge number, but even those small losses, they can add up over time.
Like a leaky faucet, right?
Yeah.
You don't want to ignore it. So why are customers leaving? We got to understand that, right? And then take steps to address those issues. Maybe they're not finding enough value in your service, or the experience isn't great. Maybe customer service needs a little love. By figuring out why people are leaving, well, you can start plugging those holes, keep your customers happy, and coming back for more.
Exactly. It's like being a detective. You got to investigate, find those clues, and then solve the mystery of churn.
Okay, so we've got ARR, CAC, LTV, churn rate. It might seem like a lot to keep track of, but I promise you, understanding these metrics is super important.
It's like having a superpower for your business. You can analyze your performance, make better decisions, and ultimately achieve greater success.
You're in control. All right, so wow, it's been an incredible journey exploring this whole world of startups and small businesses.
We've covered so much ground.
I mean, we decoded all that lingo, those funding strategies, and even dove deep into those essential metrics. But you know what? This is just the beginning of your adventure.
It's true. The world of entrepreneurship, it's vast. It's always changing. There are always new ideas, new technologies popping up, new ways of doing things. So stay curious, keep learning, and never be afraid to take that leap and pursue those dreams.
Yeah, embrace the unknown. We hope this deep dive is giving you the knowledge and inspiration you need to navigate this exciting world of business.
Whether you're starting your own company or just looking to learn more, remember, every journey begins with a single step.
So go out there. Embrace the challenges, celebrate those victories, and make your mark on the world.
That's what it's all about.
Thanks for joining us on the Deep Dive. Keep exploring, keep innovating, and keep those entrepreneurial spirits soaring.